Stock Market Documentary Channel presents.
Peter, I want to start with you. We talked a little bit about China right there with Aaron. You've said this crash has less to do with what's going on with stocks in Beijing and more to do with the Feds, in your words, propping up the U.S. economy. Why?
Well, first of all, let me update your viewers. Maybe Aaron hasn't checked her quotes, but the Dow finished down 200 points. It was up earlier this morning in a classic reversal Tuesday or turnaround Tuesday fake out. But this market closed on the lows, very weak. It's going to be a scary day going into tomorrow. Probably we're going to go back at a minimum, retest the lows from yesterday morning when the Dow opened down 1,000. But all this scapegoating about China, this is not about China. This problem is made in America. It's all about the Fed. The Fed inflated this bubble, and now they're threatening to prick it. Everybody expects the Fed to actually raise interest rates. I've been saying all along that it's been a bluff, that there's no way the Fed could raise rates, because if they did, we'd have another financial crisis, not just a recession and a bear market, but we would resume the financial crisis that they interrupted. This market is all about the Fed. That's the only thing that's been propping it up. And if the Fed takes away the 0% interest rates, this market's going to implode and we're right back in recession. That is the real story. And that is what is hurting markets around the world. It's the fear of higher interest rates. That's propping up the dollar. That's depressing emerging markets. That's depressing commodity prices. This is the problem. But nobody believes or realizes that the Fed is bluffing.
Well, Mark, do you agree here that the problem is all with the Feds? Peter sounds pretty bleak, especially even going into tomorrow's market. What do you have to say?
No, I don't think the Fed is the problem. The Fed should never be thinking about raising interest rates. The problem is kind of the opposite, I think, of what Peter sees. The problem is that this has been a very weak recovery for the United States. You know, we're about 8.5%, our GDP is about 8.5% bigger than it was at the peak before the Great Recession, which is quite a long time ago, very little growth. For comparison, China's over 80% bigger than it was at the peak before the recession. Europe has just barely caught up with its pre-recession peak. So it's the two biggest economies, the European economy and the U.S. economy, that are the problem. And the European economy is the much worse problem because they've got twice, you know, in the Eurozone, they have twice the unemployment that we do because they followed the wrong policies. They had a central bank that was actually hurting the economy. They didn't have a stimulus like we did. In fact, they did the opposite to the more vulnerable countries. So the problem is a lack of aggregate demand. That's the big problem in the world. The Fed has done its part by keeping interest rates this low, this long. What we really need is more from the rest of the government. We need an expansionary fiscal policy. We need, you know, infrastructure investment, things that will create jobs, because we're still down about 3 or 4 million jobs from where we should be right now, in spite of the unemployment rate, because many people have dropped out of the labor force.
Peter, I hear you wanting to jump in. I have a question that I want to ask you, though, which is, do you not agree then here that this has something to do with recovery? I mean, we talk a lot about the stock market. Is it an indicator of the actual economy? Aren't most Americans just concerned about employment?
No. First of all, you know, the stock market is a bubble. The reason we haven't had a real recovery, the reason that the average American is worse off today than he is when the recovery began, is because the Fed hasn't allowed a recovery. This cheap money, quantitative easing, 0% interest rates, is interfering with that recovery. Real economic growth comes from savings, capital investment, underconsumption. None of that is happening. We're getting a bubble. The Fed is diverting resources from Main Street to Wall Street. The last thing we need is what the other gentleman just said. You know, our unemployment rate is actually much higher than the government claims, because we're not counting all the people that have left the labor force, all the people that are working part-time jobs who want to be working in full-time jobs. We're not going to turn that around until we turn the government around. That means we need a smaller government. We need higher interest rates. We need to have a real recession in order to have a real recovery. Now, I agree there are problems in Europe, but those problems are not caused by monetary policy being too tight or by government deficits being too small. We have too much government in Europe, and we have too much government in America. We have too much money printing. Interest rates are too low. What we need is capitalism. That's the thing. That's what's going to save Europe. That's what's going to save America. But unfortunately, we're going to have to go through a lot more pain before we get a real solution.
All right, Mark, what is your response to what Peter's just outlined here, that the Feds need to basically raise interest rates in order to rip off the Band-Aid, I guess, and put us through a little bit of recession.
Yeah, well, he said the real recession. I think that says it all. We need a real recession, is what he said. Now, that's why I think his views are never going to be taken seriously by the majority of people. Most people care about having a job, you know. Peter has a job, so he doesn't work.
Jobs.
Okay.
But what's your solution then, right? So if we raise rates, right? If you raise rates, wages they drop,
yeah,
right? So that's not good for the average American. How can there be a recovery for the average American when we're not just talking about stocks?
Well, there has been some recovery. That's why it's important to compare Europe with the United States. Again, they have twice the unemployment by the same measure. They have twice the unemployment that we do in the Eurozone. Okay, why is that? Because they made a real recession. They had a second recession for 2 years.
They have
after
higher
the first
minimum
one.
wage laws.
Can I finish? I don't remember interrupting you. Sorry. Okay. They actually made the economy worse, whereas our government didn't do enough. Okay, but they at least did something. We had a stimulus, and we had the Fed's policy, and we had quantitative easing, years before the Europeans did it. So those things actually help. Now, if Peter wants to complain that too much of the money went into the stock market and that prices are too high, okay, fine. But at least there was growth. At least unemployment went from its peak of 10 to 5.3%. And again, that's not enough because, as he mentioned, there's a lot of people who dropped out of the labor force. So we are down, again, 3 to 4 million jobs. But the point is, he's talking about making it worse, having a real recession.
No.
What? Look at Europe.
No, I'm not. Look, let me get a word in here. Because, first of all, Europe has always had higher unemployment because of their rigid labor laws. That's not something new. But look, I don't want a recession because I enjoy the pain. Right? What I want is, if I see a drug addict, I want him to go to rehab. You see a drug addict and you want him to take more drugs. I recognize that the guy's got to get healthy. He needs to go through withdrawal so he can have a healthy life. You just want him to feel good. You want to give him more drugs. I know what ails this economy. It's too much cheap money. It's too much government. It's too much regulation. It's not enough real economic growth. And it's too much bubble blowing by the central banks. We need to shrink government. We need to go back to sound
Peter,
money.
I'm going to have to jump in. The tragedy of the live show is that we never really will get to wrap up this debate. And I guess for now, the two of you are going to have to disagree, and I'm sure as the numbers continue to go all over the place in the markets, have to have both of you back on, and I wish we had more time. I really do. I guess we can all agree that the recovery, I guess, is the bottom line, is what hasn't worked out as much as many Americans would hope. I think both of you can agree on that at least. Mark Weisbrot, co-director of the Center for Economic and Policy Research, and Peter Schiff, the CEO of Euro-Pacific Capital. Thank you both.
Thank you for watching. Please subscribe to our channel. Stock Market Documentary Channel presented.